All right, let's dive into the latest earnings report from the professional services firm RGP. Now, management showed up with a story about some pretty big challenges and, a brand new plan for the future. But the market, well, it had its own opinion and it didn't wait to share it.
And that opinion was not great. The verdict came in fast and hard. In after-hours trading, the stock just tanked, dropping almost 12%. A move like that really tells you everything, doesn't it? Wall Street basically ignored any of the good news and went straight for the jugular, focusing squarely on the problems.
So here's the fundamental push and pull of the whole report. On the one hand, you've got a beat on adjusted earnings per share. That's good. But on the other hand, a miss on revenue. And let me tell you, in this market, everyone is obsessed with growth. So that revenue miss, especially when you pair it with a weak outlook, well, that's pretty much all that mattered. And look, the new CEO, Roger Carlisle, he wasn't trying to sugarcoat anything. He came right out and said it. A continued lack of positive momentum and a clear need for decisive actions. When a CEO talks like that, they're not just managing expectations. They're sending up a flare. They're telling you, hey, big changes are coming. Okay, let's break down the actual numbers. You can see revenue landed at about $118 million, just missing what analysts were hoping for. So you're probably asking, how on earth did they beat on adjusted earnings? Well, that adjusted number pulls out some one-time items, and the answer is they got really aggressive with cutting costs. But this just proves the point, right? A small earnings beat that comes from slashing costs just doesn't impress anyone when your top-line sales are going in the wrong direction. And this is why nobody was impressed. A nearly 20% drop in revenue compared to the same time last year. I mean, that is a huge contraction from the $145 million they did a year ago. We're not talking about a little slowdown here. This is a flashing red light that tells you client demand has really, really softened up. So is the worst over? Well, if you ask management, the answer is no. They're guiding for revenue to fall again next quarter, down to a range of 105 to 110 million. And on top of that, their gross margins are getting squeezed. This forecast is basically them telling us, buckle up, this turnaround is only just getting started. But, a new CEO often means a new plan. And that's exactly what we got. Roger Carlisle came in and laid out his 3-point strategy to get this ship stabilized. Honestly, the entire bull case for this stock from this point forward boils down to just one simple question. Can he and his new team actually pull it off? And the plan itself is pretty much a classic by-the-book turnaround strategy. It's all about stabilizing first. Step 1, get your cost in line with your new lower revenue. Makes sense. Step 2, refocus your main on-demand business to give clients what they actually want today. And step 3, try to grow the higher margin consulting side of the house. It's a foundational plan, It's not about moonshots, it's about making sure the foundation is solid before you try to build anything else. So, what gives them the breathing room to actually do all this? The answer is a really healthy balance sheet. I mean, cash is king, right? And in a turnaround, it's basically your oxygen. With over $76 million in cash and only $10 million in debt, RGP has a ton of flexibility. They don't have to rush. They can execute this thing from a position of strength. Now, let's just zoom out and put this whole story into perspective. Over the last year, while the broader market and similar sectors have been doing pretty well, RGP stock has just gotten crushed, down over 40%. This massive underperformance is exactly why the market has its arms crossed right now, basically saying, don't tell us, show us. Which, of course, brings us to the big question. We've weighed the ugly revenue decline and the weak guidance against the new CEO's plan and that strong balance sheet. So what's our call? How should you be thinking about this stock over, say, the next 6 to 12 months? All right, here it is. Our call for the next 6 to 12 months is an underperform rating. We think the stock is probably going to lag the rest of the market until we see some real, tangible proof that this turnaround is actually working. Look, this story has potential, for sure, but the headwinds right now, they're just too strong to ignore. So here's the thesis. What's the trade? For us, it's to stay on the sidelines, avoid starting a new position here. Now, you could argue for shorting it, but that's risky with all that cash they have. So what could make us change our mind? We're watching for 2 specific things. Catalyst number 1, we need to see next quarter's revenue come in at least within their guided range, hopefully above it. That would signal that they've found the bottom. Catalyst number 2, we need to see their adjusted EBITDA margin, which is just a good way to measure core profitability, start to tick up from its current 3.4% as those cost cuts start to work. Until we see one or both of those things happen, this stock is likely going to stay in the penalty box.
Okay, and as always, please remember this analysis is for informational purposes only. This is not financial advice.